Well, welcome everyone to our first weekly update in June. We got a lot to cover, so let's get right into it. If you have questions you want to see answered on future installments, service@o'harewalt.com, or you can text us 414-644-0060. First question, it appears tariffs have changed again. Boy, doesn't that feel like I could put that on this every single week. What does this mean for the stock and bond market outlook? Yeah, I think there's supposed to be a call between President Trump and President Xi at some point. I don't know how that's going to go. It may or may not happen before this call comes out. And I don't know. It might rock the market that day in one direction or the other, depending on what happens. It's very difficult to tell on a very, very short-term basis. We've had a lot of trade deals come forth, fall through, get moved around, shifted, 90-day delays. But what does it mean for our stock and bond outlook? Ultimately, our outlook should be further on than just the next few days. It's supposed to be at least a year, and really, ideally, you should be looking at what do we think of the next 5 years. And stocks are driven by profits, and bonds are driven by rates of inflation, and not necessarily our short-term expectations. And that's this very first chart that actually Goldman put together for us. Soft data, so survey data, right? Asking people what do they think, and then that's the dark blue line is current conditions. What do you think of today? The light blue line is what do you think of tomorrow, right? Future expectations, and the pink line is what data we've actually gotten that we can verify. And when we look, you can see there seems to be very close ties between survey data expectations, but the hard data doesn't seem to move that much. And this goes back to March 4th and then encompasses Liberation Day and basically the month following. Well, it tells me that survey data might not have been as reliable as people hoped. People's expectations or nerves about these things were overblown. Well, that's not unrealistic. And I think when I'm talking to people, I'm talking to clients, I'm talking to manufacturers, they say things like, I'm not worried about tariffs, we've got a way around it, or we've got a solution in place, or we have some ideas of what we're going to do, but I know my neighbors are worried about it. And the thing is, if I ask 100 people and they all say that same phrase, my neighbor's worried about it, but I'm not. Well, maybe nobody's really worried about these things. Maybe behaviors haven't changed as much as people expect. And if that's the case, the hard data would not bear out those concerns. And by the way, uncertainty is never good. Uncertainty can in and of itself cause its own problems. But maybe we don't necessarily realize from a survey what the actual data might look like. And if that's the case, that's where market data comes from, is what are our future expectations of spending and profits and GDP growth. And maybe that hasn't changed as much as the initial shock of, sort of the tariff announcement 2 months ago might have caused. We do have some mild contractions. A lot of the economic data has been looking very, very good. But, this one is ISM manufacturing data. The dotted line there is 50. Anything above 50 is growing. Anything below 50 is contracting. We're at 48.5. Not too far off from neutral. Slight contraction. But you notice it's been in slight contraction now for really the past couple of years, which is why people have talked about the rolling or hidden recession. Manufacturing has been sort of experiencing recession kind of for a while here. And remember, manufacturing is about 10% of the U.S. economy. So it in of itself is not large enough, right? Now, by the way, back in the 1970s, it was close to 30%. It is not in and of itself large enough to cause a recession unless there's massive, massive, massive declines. Services are 70% of the U.S. economy. And the ISM survey data we just got shows that we are in a mild contraction, 49.9, basically almost neutral growth for the month of May. So yeah, actually the economy between manufacturing and services, the last one is governments. Governments usually still spend more money, even despite all the talkings going on. We're having basically neutrals in services, slight unders in manufacturing, and probably neutrals in government. That's not a massively contracting economy. That's not a spiral out of control. So does it help predict a recession? We don't think so. We think it's probably still relatively stable, and things look pretty good for the rest of the year. So no, is the whatever the news is of the week, is it going to change our outlook? No. And if you look back at 2017 when the tariffs were first announced, well, fast forward in a few years, nobody cared about tariffs. That was not the driving story for the next 5 years. But it feels like it now. And there's oftentimes stories that get us all worked up, and then 5 years later we wonder, why we were so worked up about them. Well, this is probably one of those where on a 5-year outlook, it probably won't have a huge net negative effect. Should we follow the old adage, sell in May and go away? When I read that, all I read is, should I try to time the market using historical data? And whenever somebody says, should I try to time the market, my answer is probably not. So let's look at a chart on exactly this. Comparing $100 invested in 1990 in the S&P 500, if you'd put it in 1990, the last 35 years, at the end you'd have over $1,500 if you'd left it in the entire time, reinvested your dividends and so forth. And giving a little bit of credence to the phrase, if you'd only done it in the winter, right, November 1st to May 1st, you got out in May, you'd have $811. And if you'd only done it in the summer, just the May, if you'd been in the light period, you would be worse off. But the comparison isn't winter to summer, it's full year to winters only. And, well, you're almost twice as well off if you are in it for the entire year. Not to mention, the cost of employing a strategy like this, and taxes and churn and other issues that might arise. Besides that, this is just looking at what the raw numbers would be. No, it's never better to time the market. It's always more time in the market. And the example I've used several times is you want to be able to keep playing the game, even if you do lose. If you've got an advantage playing, the house, you want to keep taking it. I mean, casinos don't win all their money at once. They win it because they know the odds are in their favor, and they just get a lot of people to play many, many, many times. They have time on their side. That's how they win over time. They win, dollars at a time, and then they make big payouts every once in a while. But they win dollars at a time. They just know that the odds are in their favor. That's why many of the games are 48% favored toward the player and 52% toward the house. It doesn't sound like a lot unless you play millions and millions and millions of times. And if you get to play many, many, many more times, if you know the odds are in your favor, and we do know the stock market is very powerful and tends to go up over time, because it's in our favor, we tend to do better over time. So I would not advise anybody to sell in May and go away. Even if you have moderate returns for the summer, the cost of being out or missing a big upward move is probably, it could be a year's returns. With that, that's going to conclude our 2 questions, 5 types of wealth. We got a short video on it here. Hopefully you follow up with that. Thank you for joining me today. I very much appreciate it, and we'll talk to you all soon.